Hey everybody, this is Coach D here with Tackletrading.com, and in this video we're going to talk about what to do when a bull call debit spread goes bad. I'm going to start you out here by walking you through the chart of NFLX and why I think that the sentiment is changing potentially from bullish to bearish, and talk about the choices we have when it comes to trade management, exiting trades early, reducing risk, and or potential adjustments and repairs that can help us preserve capital. That's really what we'd be after here. So the general idea here, what I'm seeing on NFLX that makes me think that sentiment is changing, other than the fact that I think some of the broad market sentiment is changing, is one, we see an old resistance point here in a double top. So we actually have a double top, which doesn't necessarily mean it's done, going up, but we're seeing some increased selling pressure right here, an uptick in some of that volume, and I believe a general violation of the trend, the 50-period moving average. It's now violated the 9, the 20, and the 50-period moving averages. We're just seeing some downward pressure here. And it may stay bullish, but I have concerns about that, and I believe it's turning more bearish. And therefore, it's important to have a plan for trade management and exit strategy. Now, back when it was breaking out and looking like it was breaking to new highs, we threw on a bull call debit spread. And the bull call debit spread was essentially buying a 540 call for $37.90 for November, and then selling a 560 call out of the money for $31.45, giving us a 20-point difference between the two strike prices, and it reduced the cost base down to $1,290. So the debit was $1,290, and then the upside potential was $2,710. And in order to really get that maximum gain, it had to get out above 560, which at the time, 560 is just right out here above these highs. So the idea was that, hey, this is going to break out. It's going to keep running up. It might test 600, might keep going higher. And having a reduced expense on that debit spread, for $1,290, you could play the upside and have some, reduced risk to the downside. Now, it's moved the wrong direction, and this trade is down a little bit. Let me just show you here how it's looking on the P&L, and it's down $245, which isn't bad. I mean, it could be worse, could be better. You could take that and just take that loss as is and just stop out. Just be done with the trade and say, you know what, that's not going up. I think it's going down. Tap out, be done. And in order to do that, you would simply close out the call options you bought and buy back the call options you sold. That's a simple strategy. Exit the trade. I'm going to show you one other trick that I think might interest you. And really, if you like this trick, what I want to do is encourage you to come hang out with us over at Tackletrading.com, and let me just show you how this works. So what I'm going to do is show you a simple adjustment strategy that could take and potentially turn what would be otherwise a losing trade into a potentially, a winning trade or a break-even trade. And in this case, the adjustment's relatively simple. I'm going to convert the bull call debit spread, and I'm going to turn it into a ratio by selling just one more 560 call. Now, if I were to do that, let me go add the simulated trade here. And here I have those November contracts. And there you can see the out of the money, the 540 and the 560, which again, at the time, was when the trade was placed, was a better outlook. And now that it's potentially dropping more, we can sell one more 560. Now, in order to be able to do this, you have to be authorized to sell a naked call. And that would require a higher trading authorization. You need to get that proof through your broker. But the idea is, look, I can just sell one more of those. And now I am no longer in a bull call debit spread. I'm in a ratioed spread. And in doing so, now I have a new break-even point out here above the probability. So I'm going to go set that slice to break even. Set that on the chart. And the idea is, look, this trade doesn't get in trouble unless it actually breaks up and runs up above $600. That's where the break-even point would be, and it changes the trade bearish. And now, if it keeps dropping or stays down, you could make up to $730. Now that means we'd be stuck in the trade through November. And if it ran up, our original thesis was bullish. If NFLX were to maintain bullishness, that would become a problem. We need to either pull back off that leg or add another long call to turn it back into the debit spread. But I digress. Let me go set that on the chart. Set the slice to the chart. So now you can see it has to stay below that line out there, $600, below the old resistance. And again, if I start seeing buy signals, I can close that trade out early and change the adjustment. But if it keeps running down or stays down here, and again, anywhere down here, you'll walk away from the trade with a potential gain. So again, bull call debit, bought 2, sold 2. By adding on a third leg and bringing in $2,025, that original $1,290 debit, you'll actually wind up with a credit up to $735 more if you were to get filled at that price. And a trade that's now bearish, that you notice it brings in a negative delta, and it turns the trade from theta negative back to theta positive. By selling that extra option, we're no longer losing on the time decay. We'd actually start making money on the time decay. Now here's the trick. That's going to take some margin. So if you look over here, you'd have to have $6,897 in margin available to do that. Now, if you don't have that kind of cash available, one other trick for you that you could learn is you just go buy one of the cheapest out of the money calls you can, and it would potentially reduce your margin. So you might have to throw a little bit of money out of it, but I could go buy like that $900 call, and I could pick that up for $90 or so. Get that bid-ask spread down to $90. And if I can get filled on that, I no longer have a naked call option, and it brings the BP effect down a little bit. You could have to throw a little bit more money at it. If I wanted to spend a little bit more money, I could reduce that, by the $800 call, and that would require less margin. So there's tricks you can do to control the margin. Hope you enjoyed this video. If you liked it, click on the like and subscribe button, and come hang out with us over at tackletrading.com to learn more really cool tricks and techniques.